Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on depreciation of non-current assets by taking a question which involves a different scenario. In our previous video, we looked at a case where we were calculating depreciation based on the 1-month ownership basis. In this video, we are going to look at a situation where there is full year's depreciation in the date of acquisition and there is no depreciation charged on the date of disposal or in the year of disposal. And so that is what we are going to do. And so without wasting much time, I want us to straight away take the question and then we'll solve it together. The data below was extracted from the books of Chairman General. So we have the non-current assets as machines. So we have non-current assets, we have cost, date of purchase, and then the date of disposal. Now, with the machine number 1, it was bought at the cost of 2,000 Ghana cedis, and the date of purchase is 1st January 2011, and the date of disposal is 1st October 2014. And then we have machine number 2 for 3,000 Ghana cedis. Date of purchase is 30th June 2001. There is no date for disposal. It means that the asset was not sold. And then we have machine number 3 for 4,000 Ghana cedis cost, and the date of purchase was 31st December 2012. And the date of disposal is 30th June 2014. Then the last machine was bought for 5,400. The date of purchase is 1st December 2003, but it has not been disposed of. All right, so we have the additional information. A full year's depreciation is charged in the year of acquisition, and no depreciation is charged in the year of disposal. Then, second one, machine number 1 and number 2 are depreciated 10% on reducing balance, while number 3 and number 4, 10% on the straight line basis. The final one says that accounts are prepared to 30th November each year. You are required to show A, the machine account as it would appear on 30th November 2014, and then B, prepare a provision for depreciation and assets disposal accounts, assuming the machine number 1 was sold for 1,500 Ghana cedis and machine number 3 for 3,000 Ghana cedis. All right, so this is the question that we are going to solve. We are told that no depreciation should be charged in the year of disposal, and a full year's depreciation is charged in the year of acquisition. And that is quite a different scenario from what we did. Now, we all know that as for the motor vehicle account, these conditions do not affect it because I told you it is a cost account. So we are just going to prepare based on the costs. Okay, and even if we are disposing of, we just transfer out the cost. So machine account will be very easy to prepare. But the main job is with the provision for depreciation and the disposal. And with that, I would want us to do a workings and try and calculate the depreciations first. I want to organize it into a statement of depreciation so that from there we can move straight and prepare the accounts. All right, so you can follow me and just pay attention as I prepare the statement of depreciation for us. Okay, so let me just do this. Okay, so I'll call this place machine number 1 with a Ghana cedi sign up here. Machine number 2 with a Ghana cedi sign here. Machine number 3 with a currency sign, and then finally machine number 4 with a currency sign. And then I'll extend and call this place total. And then I'll use this place for the years. So I will say years. All right. And so this is how I'm going to go by my statement of depreciation. We begin now. We are starting The first year is, now one thing you should take note is that the accounting year ends on 30th November. Take note. So it means that the accounting year begins 1st December and ends 30th November the following year. And that you should be mindful of. All right, so machine number 1 was bought on 1st January 2011. And so we'll start the first accounting year, ends 2011. And then it was bought on 1st January. Remember that accounting year begins 1st December. So if we were using the 1 month ownership basis, it would have been 11 months that we use to calculate. But because the condition says that full year's depreciation in the year of acquisition, we don't care the number of months it's spent or it was used in the business for that accounting year. And so we'll just go straight away. And then we are told that machine number 1 and number 2 are depreciated 10% on the reducing balance, whilst number 3 on the straight line method. So we are going to use the reducing balance for that. But it's 10%. And so for machine number 1, it's going to be 10% of 2,000. And that is going to give us 200. And so for the first asset, we are going to have 200 cedis for depreciation for the first year. And then we look at machine number 2. In the year 2011, was this there? Yes, it was bought in June 2011. And full year's depreciation is to be calculated in the year of acquisition. So even though it is in June, we are not going to calculate the number of months because we are told full year's depreciation on the year of acquisition. And so the same 10% of 3,000, we are going to have 300 for the depreciation. All right. And that is it for 2011. The other assets were not there as at 2011. And so we can close for 2011 and put the total depreciation here as 500 Ghana cedis. That is 200 plus 300. All right. So that is for the first year. Then we move to the second year, 2012. Remember, the accounting year ends on 30th November. In 2012, machine number 3 was still not there. Okay, you let me begin with the first ones. And so in the 2012 financial year, we are going to calculate 10% on that. But remember, we are told that machine number 1 and number 2 are being depreciated using the reducing balance method. And so therefore, we have to subtract the accumulated depreciation from the cost. And that will give us 1,800. So we multiply 10% by 1,800, and then we have 180 as the annual depreciation charge based on the reducing balance method. And then we come to machine number 2, the same procedure will be used, 10% on 2,700. 2,700 is 300 minus 3,000, 3,000 minus 300 cedis. And that is giving us 2,700. Therefore, our depreciation charge will be 270 for the second year for machine number 2. And so, now, let us look at machine number 3. Machine number 3 was not purchased as at 2012. Even though it was purchased on 31st December 2012, the accounting year for 2012 ends on November 2012. Take note, 30th November. So anything that is in December 2012 will relate to 2013. And that is a trick with the dates when it comes to depreciation of non-current assets. Be mindful of the dates that are involved. I know this is an intentional trick. We are told that the asset was bought in December 2012. However, it will not relate to 2012 because accounting year does not end on 31st December. It ends on 30th November. And so anything that will happen in the 2012 December will relate to 2013 financial year. That is the meaning. And so this asset was not bought in 2012. It was bought in 2013. And so there will be no depreciation for that as well. So we can close the 2012 and then the total depreciation will be 180 plus 270, and that is going to give us 450 cedis. So no assets has been sold. All the assets were sold in 2014, the two of them that were disposed of. So let us take note that there is no disposal until 2014. And then we move to the third year, which is 2013. In 2013, still using the reducing balance method, depreciation charge will be 10% of. Now we have to take out 180 from. The correct thing is to add up these two, 200 and 180, and then subtract it from 2,000 Ghana cedis, and that is going to give us 1,620. 1,620, and therefore the depreciation charge for that year will be 162. And then we move to the next asset, which is also reducing balance method. That one too, we have to add the accumulated depreciation to be 570 and then subtract that from the 3,000, and that is going to give us 2,430. Depreciation charge for that year will be 243 Ghana cedis for the year, for the machine number 2. And then we move to machine number 3. Machine number 3 was bought in December 2012, but it relates to 2013 financial year. The cost is 4,000, and we are told that full year's depreciation is charged in the year of acquisition. So we don't even care about the date. Once it is in the year, we calculate full year's depreciation. 10%, and the cost was 4,000 cedis. It was bought at 4,000 cedis, and so we have 400 regardless of the date it was bought. We don't care because we are told a full year's depreciation should be charged in the year of acquisition, and that will be 8 for that, because with the last machine it was bought in December 2013. Even though that machine number 4 was bought in December 2013, it will relate to the 2014 financial year, because the financial year for 2013 will end in November, and so there will be nothing for machine number 4. And therefore the total depreciation charge for the year 3, which is the 2013, will be this plus that, and that is going to give us 805 Ghana cedis. And then we can look at our last year. Now, in the last year, take note of something. Machine number 1 was sold in 2014. It was sold on 1st October, meaning that it was used for about 10 months before it was sold. So if it was a 1-month ownership basis we were using, we would have calculated for the period that it was sold, it was used, the depreciation for that. But we are told that no depreciation in the year of disposal. So even if you use this for the whole year and you sold it, do not calculate depreciation for that. That is the principle. And so in 2014, there will be no depreciation for machine number 1 because it was sold. That is the meaning. But machine number 2 was not sold at all. So machine number 2 will be still available for depreciation calculation, and that will be 10%, still using the reducing balance method. The net book value after taking the accumulated depreciation from this will be 2,187 Ghana cedis, and that means that our depreciation charge for that year for machine number 2 will be 218.70. So that is what we are getting for depreciation for machine number 2 in 2014. And then we move to machine number 3. Machine number 3 was also sold in 2014. And because it was sold, there will be no depreciation in the year of disposal. So we just put a dash there. And then machine number 4 was bought in 2014. As a matter of fact, it was bought in December 2013, but it relates to 2014. And the cost is 5,400. And we are told a full year's depreciation should be charged in the year of acquisition, and so times 5,400, we have a depreciation of 540, and that is the end of our depreciation for 2014. And so when we add these two figures, we are getting a total depreciation of 758.70, and that is what we have. And therefore our total, we can also total the accumulated depreciation for each asset. All right, so the total for machine number 1 will be 542. The total for number 4 will be 540, 400 for number 3. So the total here is 1035.70. But mind you, the reason why we do the accumulated depreciation totals is for the purpose of their disposal, and therefore it is only those assets which were sold that we may need. So it means that this and that will not be useful in our account. It is the 542 and the total of 100 that we are going to use because we are going to do disposal, and that is the meaning. So when you do this, you can just decide to calculate for the machines that you sold, because that is what you will need for the account. All right, and so you can have a total depreciation, which we are not going to use for anything. I don't really want to put that there. So this is the workings for the depreciation. I'm sure you have understood it very well. Okay, so we can move on to now prepare our accounts. So let us do our motor vehicle account first. Very easy. Or our machine, sorry. Our machine accounts. So machine account, that is the asset account. And remember that I told you that with the asset account we are only interested in the cost. So let us begin year after year. So we start with 2011. Now in 2011, remember our accounting year ends on November 30th. Now so in 2011 we bought two assets, machine number 1 and machine number 2. So machine number 1 was bought on the 1st of January at, so let me call it cash, 2,000, at a price of 2,000. And then there was, on the 30th of June, there was machine number 2, which is also bought at 3,000. So that is the only thing we did for the 2011 financial year as far as the cost is concerned. And so we can just balance that off for 5,000. And then we'll say 30th of November, because the accounting year ends in November. There will be a balance carried down of 5,000. And then we move to 2012 financial year. And in 2012, the balance brought down will come here of 1st December. Remember, that is the beginning of the 2012 year, 1st December. Balance brought forward is 5,000 Ghana cedis. Now, you can decide to put machine number 1 here and number 2 here, so that you can differentiate the assets, especially for the purpose of disposal. Okay, so in 2012, did we make any acquisition or disposal? Over here, we are only interested in whether we bought or we sold, and we are interested in only the cost, not the revenue that we got from it. In 2012, we did not buy any additional assets, and then we did not sell any assets. And therefore, in 2012, we can say the last day of the year, 30th November, there is a balance carried down of the same 5,000. We'll just close it off, and then we'll move to 2013, which is the next year. On 1st December, there will be a balance brought forward of 5,000 Ghana cedis. So that is how it's going to be. All right, so now let us check whether we bought or sold some more assets in 2013. Now in 2013, we didn't sell any assets, but we bought machine number 3 for 4,000 on 31st December. Okay, and so on 31st December, by cash, machine number 3 was bought for 4,000 Ghana cedis, and that is the only thing that happened as far as this account is concerned. And so we'll close off this account, and we'll say total is 9,000, and therefore on 30th November, the balance carried down is 9,000 Ghana cedis. And then we can jump to the final year, which is 2014. And then we'll bring the balance down and say 1st December, balance brought forward is 9,000 for the asset account. So it is very, 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 very simple. For the machine account, it is very easy. We are just interested in whether we bought at the hot cost and whether we sold and what was the original cost. Now, finally, in 2014, we bought one more asset, which is machine number 4. But we sold machine number 1 and number 3 as well. So let us take note. So we will record the acquisition here and then record the disposal here, all at the original cost. And so we bought machine number 4 for 5,400 on 1st December. So 1st December 2012, there was a cash for machine number 4, 5,400. And then we look at the disposal. Now we sold machine number 1 on 1st October, sorry. So on 1st October, there was a disposal. So we call it disposal. And that is machine number 1. And machine number 1's original cost is 2,000. So that is what you are going to remove out of your total cost by crediting. So take note, even though we are told that machine number 1 was sold for whatever amount, that is not what we are interested in. We are interested in the cost, original cost. And then machine number 3 was sold on 30th June. And that one too, we are interested in the original costs, not how much we sold it for. So the original cost for machine number 3 was 4,000. So that is what we are crediting and removing out. So afterwards, we are done with 2014 as far as the machine account is concerned. And so we can close off the accounts on 30th November and have our balance carried down for the year. So the total will be 14,400 for both sides. And that is going to give us a difference of 8,400, which is going to be our balance carried down for the 2014 financial year, 8,400. And so, ladies and gentlemen, this is how our machine account is going to look like. So from here, we can proceed to prepare the provision for depreciation account and the asset disposal account. And so, let us prepare the provision for depreciation account. Provision for depreciation on machine account. So I'll put my currency sign here, and then I'll begin year after year. So I'll begin with the 2011 financial year. Okay, so we prepare the provision for depreciation account starting from the 2011 financial year. Now in the year 2011, the only thing we are going to use will be the totals that we had for each year from the statement of depreciation. And then we are going to begin from the credit side because it has a credit balance. And so on 30th November for 2011, we will say profit and loss, or profit or loss. And then the amount for depreciation for that year was 500. And so we'll write 500 cedis here. And that will be 8 for the first year. So 500 will still come on the last day as your balance carried down. And then in 2012, the balance carried down for depreciation will come as a balance brought forward. All right. And then in the year 2012, depreciation charge, we'll use the last day of the year and we'll call it profit or loss. And that was 450 cedis. Okay. And so what we do with the provision for depreciation account, like I taught you in the previous video, is that we just accumulate. All right, so we'll come to the last day of the year. Once there is no disposal, we'll just continue accumulating. But when we get to a year where there is disposal, we'll remove the accumulated depreciation of the assets. All right, so we'll say balance carried down, and then the amount will be 950 because that will be the total for the two figures. And then we will jump to the next year, which is 2013. Now in the year 2013, first day of the year will be 1st December. So that will be balance brought forward, 950. And at the same time, in that year, there was no disposal. So we just continue accumulating. And so depreciation charge for that year, which is on the last day of the year, 30th November, profit or loss was 805 cedis. Okay, 805 cedis. And so we'll say balance carry down because there was no disposal. We'll just continue accumulating. So for depreciation, what we do in the account, because it has a credit balance, we just continue accumulating. We add up every year's depreciation to the balance that is already existing. And now the total is going to be 1,755. And therefore the balance brought down, or balance carried down, will be 1,755. Okay. And finally, on the final year, in the final year, there will be a balance brought forward of 1,755. And then we'll look at the depreciation charge for the year. The depreciation charge for that year was 758 cedi, 70 pesos. So that will be our profit or loss, which is on the 30th of November. Now, there was disposal. Remember that in that year we made 2 disposals, and so we have to take off the accumulated depreciation of those assets that we sold from the accounts, from the depreciation. And so that year we sold machine number 1 and number 3. Now, so machine number 1 was sold on 1st August 2014, and then machine number 3 was 30th June 2014. So 30th June comes before 1st August. And so I will say disposal number 3. And then I will go and pick the total depreciation for machine number 3, which was 400 cedis. And I will take it out. That is the total depreciation that we are taking out of the account. And then on 1st October, there was another disposal. That is machine number 1. And that one, the total depreciation was 542 cedis. All right, so that is what we are going to do. And so when we take that out, we can now balance off the account. Also, 30th November, there was a balance carried down. And the balance carried down will be this, a total of this minus the disposals. All right. And that is 1,571.70. That is the balance carried down. And the total is 2,513.70. All right. So that is how the provision for depreciation account is going to look like. Remember that the difference is that when it comes to the machine account, we are interested in the cost. And so when we are taking out anything for disposal, we take out the cost. When we come to the provision for depreciation, it is on the depreciation for the year. And when we are transferring anything out on disposal, it is accumulated depreciation on the asset. The actual amount that we sold the assets for, the proceeds that we realize, will be factored in the machine disposal account. And therefore, I'm going to clean the cost side, and I'm going to prepare the machine disposal account as well. All right. So I prepare the machine disposal account. Machine disposal account, and we are fortunate that the disposal was only in the same year. Both of them were in the same year, so we can prepare that together. All right, so in the year 2014, that is the only year we did disposal, so that is what we are going to work with. Now remember that when we were preparing the asset account, when it was disposal, we recorded on the credit side. Every credit entry should have a corresponding debit entry. So those that we transferred out the cost will now appear on the debit here. And then the depreciation that we debited will also come and appear on the credit. So that is what we are going to do. And so for machine number 3, the cost was 4,000. And for machine number 1, the cost was 2,000. And when we come to the depreciation, we know that for the accumulated depreciation for machine number 3 was 400 cedis, and then the depreciation for machine number 1 was 542 cedis. So we transfer both the cost and the accumulated depreciations. And then we can now go and ask ourselves, how much did we sell each of the assets? Now we are told that machine number 1 was sold for 1,500 and number 3 was sold for 3,000. So we are going to find the profit or loss on disposal. And so the cash we received for number 3 was 3,000, and the cash that we received for number 1 was 1,500. And therefore that is what we are going to do. So we are going to find the difference. If we have more here than what we have here, then we are making a profit on disposal. If the debit exceeds the credit, we are making a loss on the disposals. The debit side is 6,000, but the credit side is not up to 6,000, and therefore we'll put the total of the bigger side at both sides, and we put the difference as profit or loss. So that means that there was a loss on disposal for both assets, and in this case the loss is 558 Ghana cedis. You can verify that from your calculator. And so that means that for the assets that we sold in 2014, we are making a loss of 558 Ghana cedis. This is the second scenario that I was talking about, where full year's depreciation is given in the year of acquisition and no depreciation is charged in the year of disposal. All right, so if you have any further questions, as usual, you can send it out to our WhatsApp platform and then we'll be interactive. And I also want you to look for more questions, practice on your own, and I'm sure you'll become perfect. Continue following us, subscribe to the channel. Remember to share this video, let others also have a benefit, and we shall be successful together. Until we meet again next time, it is bye for now.